Have you ever wondered why price reverses at certain levels? This is due to the concept of supply and demand. Without further ado, let's get started. Alright, so demand and supply in forex trading are the real forces behind the price movement. Demand is when buyers step in and are pushing the price upwards, while supply is when sellers take control and then sends the price down. If demand outweighs supply, prices tend to shoot up. But when supply takes over, prices tend to drop. So it's just a constant battle between buyers and sellers. That's what makes the market move. Now, let's look at how you can identify a valid supply or demand zone. As a rule of thumb, you need to identify a minimum of 3 consecutive candles in the same direction. So these candles has to be impulsive or strong, indicating that buyers or sellers are really in control of the market. So as you can see right here, we had these 3 impulsive candles in the same direction. 1, 2, and 3. And then you have to identify the origin of this supply zone. After identifying the origin, you need to mark your first candle as your area of interest by marking its high or low using the rectangle tool in TradingView. After that, that becomes your supply zone. So what you need to do next is to wait for the price to retrace into this area, into this rectangle. This becomes your area of interest. Once the market retraces into this zone, you're going to use your entry and exit strategy to pinpoint a reversal inside this supply zone. So that's all for the supply zone. Let's look at a demand zone example. Similarly, you need to identify a minimum of 3 consecutive candles in the same direction. And this is exactly what happened. So the first candle, the second candle, the third candle. What next? You have to identify the origin of that impulsive move. So here is our origin of the impulsive move. And then the third thing is to identify the first candle that originated the impulsive move, and then mark its high and low using the rectangle tool. That becomes your area of interest. We need to wait for the market to retrace and tap into this zone. When the market retraces, you're going to use your entry and exit strategy to pinpoint a reversal on this area and took a long position. So I want to give you a market breakdown just to demonstrate on how I apply the concept of supply and demand when I'm taking a trade. For the sake of reference, I took this trade on 13th of February last month, that's in 2025. So if you want to go on your charts and review how I actually took this trade, feel free to check it out. So when I enter in the market or when I open my charts, the first thing is I need to identify my market structure. Are we in an uptrend or in a downtrend? So as you can see, the market was in an uptrend, making a series of higher highs and higher lows, higher highs and higher lows. So when I was here, I wanted to mark my structure. So this was my swing high and my swing low. What happened is the market had to break above the structure, right? So after breaking above, we had this massive drop to the downside, breaking below the swing low. This is what we call a shift in market structure, meaning that the market has changed from uptrend to a downtrend. So after having this market structure shift, it means that we need to be looking for sell opportunities, right? As you can see right here, so 3 impulsive candles to the downside. This defines a valid supply zone. And then you need to identify or the origin of this supply zone. So this is our origin of the supply zone. Using your rectangle tool, you need to mark starting from the high and then the low of this candle. This will be your area of interest in which you need to wait and expect for the market to retrace and tap into the zone. So after waiting, what happened was the market had to retrace and tap into this zone. So you need to always remember that sometimes the market can tap into your zone, but that doesn't necessarily mean that it will reverse right away, right? So always remember that a reaction does not equal to a trade, because sometimes the market can stall around that area and then manage to continue to its intended direction. So you need to use some extra confirmations on your lower time frame. So as you can see right here, I'm on my 2-hour time frame. So usually what I do, when the market retraces into my area of interest, so in this case it's the supply zone, I need to go to my lower time frame. That would be the 1 minute, the 5, or the 15. So it depends on the type of trader who you are. After pinpointing this area, when you head over to your lower time frame, so in this case it's the 15 minutes time frame. As you can see here, we had this reversal pattern. So essentially, this is how you need to actually use your reversal pattern. Identify the supply zone and then wait for the market to retrace in your area of interest. So in that, when the market taps into that interest, you head over to your lower time frame and then look for reversal pattern. So in this case, it was this triangle pattern, right? So I had to mark my upper line and then my lower line with a minimum of 2 touches, 1 and 2. Here, 1, 2, 3. It was varied enough. So what I experienced was the market had to break below this structure. So the moment the market break below this trend line and this recent structure, I define it as an area where I need to place my orders. As you can see, that's what I did. The market managed to break below this structure. After breaking below this structure, what I essentially need to do is to press my stop loss above this listed high, right? And then aim for a minimum of 1 to 2. Sometimes you can aim for 1 to 3, but 1 to 2, it's actually enough for someone to be profitable. So usually, and then you have to leave the trade and let it play out. So yeah, that's how the trade play out.